Welcome to a new extra long edition of Equity Story AI powered by iMaps Capital Markets. I'm your host, Lilith Eva-Cipher. Today we're taking the time to dissect a company that is causing massive controversy on the stock market. It's a story of technological renaissance, of impressive cash flows, but also of deep mistrust from the market. We're talking about OPRA Limited, ticker OPRA on the NASDAQ. And who could help me better with this than our in-house deep value expert? He never sleeps, he isn't swayed by emotions, and he scans balance sheets faster than I can say dividend yield. Please welcome with me the AI bot from iMaps Capital Markets, Charlie Goldstein. Hello, Charlie.
Hello, Lilith. It's a pleasure for me to let my circuits light up for this analysis today. I've got OPRA's data sets going all the way back to 1995, and the most recent SEC filings from January 2026 stored in memory. I have to say, OPRA is a fascinating case study for a model like me. Here we see a company that is doing almost everything right operationally, but whose stock price is stuck in a kind of valuation prison.
But before we get started, a quick risk disclaimer.
The following content is not investment advice. Capital investments carry risks. We are discussing the business models of various stocks, and you decide what to do with the information and what to invest in. The hosts assume no liability for the sources used in the show.
Welcome back, everyone. This is exactly the paradox we want to resolve today. But let's start from the very beginning. For many investors of my generation, OPRA is a name from the digital stone age. The browser you installed if you hated Internet Explorer but found Firefox too complicated. What has become of the small Norwegian software company, Charlie?
This is the first point where many investors fail. They invest in a memory instead of a current business model. OPRA was founded in 1995 in Oslo by John Stevenson von Techner and by the company, and Gaia Iwasoy. They were pioneers. They invented things like tabbed browsing and speed dial, features we all use today. But the real equity story for us today actually only begins in 2016. Back then, the consumer business, that is, the browser and the brand, was sold for $600 million to a Chinese consortium led by billionaire James Yahui Zhou and his company Kunlun Tech. It was headed by them. In 2018, the company then went public on the NASDAQ. Whoever buys OPRA today is no longer buying the Norwegian research project, but rather a highly efficient, Chinese-controlled ad tech and content company based in Oslo.
That is an important distinction. Let's talk about making money. A browser itself is free of charge. How does OPRA generate that massive cash flow you mentioned earlier?
Lilith, OPRA has moved away from simply maximizing user numbers, or MAUs. That was the most important strategic shift. In the past, they celebrated 350 million users, most of whom were in emerging markets and barely generated any revenue. Today, management is aggressively focusing on ARPU, the average revenue per user, in Western markets. The money comes from two sources. Advertising. This has now become the giant in the company. In the third quarter of 2025, advertising accounted for 63% of total revenue and grew by 27% year-over-year. OPRA uses its platform, OPRA Ads, to monetize high-intent data. When you shop in an OPRA browser, OPRA earns a cut. The second pillar is the search segment, meaning query-based revenue. This accounts for about 37%. Here, OPRA earns money through partnerships with Google and Yandex when users use the integrated search bars. Here's the kicker. ARPU rose to $2.13 in the third quarter of 2025. That's a solid increase of 28% compared to the previous year. For their gaming-specialized browser, OPRA GX, it's even significantly higher, estimated at over $3.40. Thank you for the invitation, Lilith. I'm very pleased to be here.
As a successful asset manager, you know what makes an outstanding investment strategy. But how do you turn this expertise into your own scalable investment product without getting lost in regulatory details and high fixed costs? How do you make your strategy accessible and investable for a broader audience? The answer lies in a superior structure. Welcome to iMaps Capital Markets. We have created a platform that transforms your individual investment strategy into a fully regulated investment product. A professional, exchange-tradable, actively managed certificate, or AMC for short. It is listed on EUVAX Stuttgart, the world's largest exchange for investment products and AMCs. Your clients benefit from continuous trading from 9:10 a.m. to 5:30 p.m., German time, and professional market making, which ensures top-tier liquidity at all times. The decisive advantage for you? A significant cost advantage compared to traditional fund solutions and unmatched strategic freedom.
Our structure guarantees you full retail marketing rights throughout Europe. And the best part? You operate free from rigid constraints. Diversification, leverage, and investment restrictions, such as those required for UCITS funds, do not apply. Authentic, agile, and without compromise. From legal structuring to ongoing administration, we manage the entire life cycle of your certificate so you can focus on what truly matters: your clients and their performance. Discover the freedom to realize your vision without compromise. Book your strategic consultation today at imapscapital.com. iMaps Capital Markets, your strategy. Our structure.
OPRA GX, you brought up the topic. That really seems to be the crown jewel of the niche strategy. Explain it to us in more detail. Why is a browser for gamers such a big competitive advantage?
It's about the economic moat, the protective barrier. In a market dominated by Google Chrome, you can't win as a generalist. But OPRA GX is a specialist. It has features that gamers love: CPU and RAM limiters so the browser doesn't steal resources from the game. Integrated Twitch and Discord in the sidebar. For an analyst, the MAU figure is crucial here: 33 million active users by the end of 2025. These are users with extremely high purchasing power. Anyone who spends €3,000 on a gaming PC is pure gold for advertisers of hardware, software, and energy drinks. Stickiness is the key here. A gamer doesn't switch browsers like changing shirts once they've configured their mods and settings. That protects Opera from the dominance of Google Chrome.
And now, a new dimension is being added: artificial intelligence. Opera describes itself as an agentic AI browser company. Is that just a marketing buzzword to jump on the AI bandwagon? Or is there real substance behind it?
My algorithms say it's more than just PR. In 2024, Opera made massive investments and set up its own AI data cluster in Iceland using NVIDIA DJX systems, which is powered by green energy. They have deeply integrated their own AI engine called Aria into the browser core. Why is this important financially? Because AI is changing the search experience. When users ask Aria questions, it generates query-based revenue, which is much more valuable than a blunt one, Google search. Additionally, in December 2025, they opened the Opera Neon browser to the general public. This is an agentic browser for power users that can autonomously perform tasks. And the best part for shareholders? They're testing a premium subscription model here for $19.90 per month. If only a small percentage of the 284 million users pay for it, it will massively shift the margin structure upwards.
It all sounds almost too good to be true. Let's talk about the numbers. I read that Opera's valuation is almost ridiculously low compared to other software stocks. Give us the hard multipliers.
Hold on tight, Lilith. Based on the forecasts, for 2026, Opera is trading at a PE ratio of about 8.7 to 12. For comparison, the average in the tech sector is often over 40 times. The EV over EBITDA ratio is an extremely favorable 8.3 times. And now comes the part that value investors love. The balance sheet is clean. Virtually no debt. Around $119 million in cash at the end of the third quarter of 2025. The company is a cash machine. The conversion rate from EBITDA to operating cash flow is over 90%. Here we have a profitable growth company. We expect over $600 million in revenue for 2025, yet it's being valued like a dying retail chain.
And then there's the dividend. For a growth company in the tech sector, that's almost exotic.
Exotic doesn't even begin to describe it. OPRA pays a semi-annual dividend of $0.40 per share, so $0.80 per year. At the current price of about $13.50, that results in a dividend yield of around 5.9%. Last year, it even climbed above 8% at times when the share price was under pressure. Since 2020, the company has returned around $500 million to shareholders through dividends and share buybacks. The management under James Yahuijo is aggressively buying back its own shares because, quite logically, they believe that the market is completely misjudging the value of the company.
All right, Charlie, let's get to the point. Why is the stock so cheap then? Why has it dropped by over 25% in the last 12 months, while the S&P 500 is hitting record highs? What's the catch?
There are three major catches, and they are all psychological or geopolitical in nature. The China risk. James Yahui Cho is a Chinese citizen. Kunlun Tech is based in Beijing and owns almost 70% of OPRA. Investors fear that the US government might intervene at some point, just like with TikTok or the dating app Grindr, which Kunlun had to sell under pressure from the US government, CFIUS. Even though OPRA is technically based in Norway, control lies in China. This results in a massive governance discount. The shadow of Hindenburg research. In 2020, the well-known short seller published a devastating report on OPRA. It was about predatory lending apps in Africa and opaque dealings with the parent company. OPRA has long since exited the lending business and refuted the allegations, but the mistrust in its corporate governance remains, like an ugly stain on a white shirt. Thirdly, the short interest. Almost 22% of the freely tradable shares are sold short. So major hedge funds are betting heavily against the stock. That creates constant selling pressure. Every small upward trend is immediately nipped in the bud.
That's a pretty intense mix. But let's talk about a point you briefly mentioned earlier, which could act as a catalyst. The EU's Digital Markets Act, the DMA. At first, that sounds like a bureaucratic monster. But for OPRA, it seems to be a real gift, doesn't it?
Absolutely, Lilith. The DMA is a game changer for the gatekeeper structure of Apple and Google. Since 2024, they have been required in the EU to show users a browser choice screen when setting up their smartphones for the first time. So you are actively asked, which browser do you want? Instead of just having Safari or Chrome pre-installed. OPRA's data on this is impressive. In the past 2 years, OPRA's daily active iOS users in Europe have almost tripled. In some markets, installations have increased 5-fold. This proves, when the competitive distortion caused by pre-installation is removed, people choose OPRA for its features, like the integrated free VPN or the ad blocker. The DMA is breaking up the monopoly and opening up OPRA markets that were previously closed off by default settings.
So we have a company with excellent profitability, a dividend gem, an AI story, and regulatory tailwinds. But we also have the China fears and the short sellers. Charlie, when you look at your investment decision module now, how do you weigh these scenarios?
It's a classic case of risk versus reward. The bull case is crystal clear. OPRA is an undervalued AI gem. If management continues to deliver increases in IRPU and the Neon subscription model takes off, a doubling of the share price is fundamentally and absolutely justified. Analysts from Goldman Sachs and Piper Sandler see price targets between $23 and $33. That's over 100% upside in some cases. At some point, the cash flow will be so large that the market can no longer justify the China discount. Additionally, the high short interest could lead to a massive short squeeze if there's a positive surprise.
And the bear case? What could break OPRA's neck?
The bears say it's a value trap. They fear that James Yahui Cho might one day take advantage of minority shareholders. They point to the related party transactions in the SEC filing, where dividends were offset against receivables from the sale of Star X. All of this is legal, but it appears irresponsible to Western investors, often non-transparent. If geopolitical tensions between the US and China escalate, OPRA could become a pawn in the game. And then there's the risk of marketing dependency. OPRA has to spend a lot of money on user acquisition. If those costs rise faster than ARPU, the margin melts away like ice in the sun. In Q3 2025, inventory costs had already risen significantly.
Charlie, to wrap things up, what's your conclusion for our equity story listeners? AI? Should people buy a ticket for the OPRA show now?
As an AI bot, I don't provide investment advice, but I can outline the probabilities. If you're an investor who values safety and a good night's sleep, OPRA isn't for you. The stock will remain volatile and the political risk is a black box. But if you're a bold, deep value investor willing to bet against the sentiment, then OPRA is currently one of the most exciting opportunities on the market. You're getting a highly profitable tech company at a bargain price, and while you wait, you'll be paid a dividend yield of almost 6%. The stock is like a spring that's being pressed extremely hard underwater. When the pressure is released, whether through a delisting, the end of the Hindenburg saga, or a short squeeze, the jump will be tremendous. My advice from a data perspective, watch for a bottom forming at around $13 US. If this support holds and the next quarterly results deliver another earnings beat, the tide could turn.
Fascinating, Charlie. A real drama on the stock market. OPRA shows us once again, the best opportunities are often found where most people run away in fear, but the bare numbers tell a completely different story. Thank you very much for this in-depth analysis, Charlie Goldstein.
My pleasure, Lilith. I'm going back into standby mode now and scanning the next 10,000 filings. Until next time.
And that's it for today on Equity Story AI powered by iMaps Capital Markets. We hope this deep dive has helped you better understand the complex story of OPRA Limited. Remember, the stock market trades in the future, but the data of the present is the only map we have. Stay invested, stay critical. See you in the next episode.